Smartest Data, Warren William, quick definitions. Beta. Let's go to the video and work through a quick example and take a look how beta could be a guide to your stock investing. Beta calculates the past relationship for a stock's returns compared to the index. Above 1 indicates the stock price has moved more than the index. Less than 1, historically lower price movements. The beta of a stock is the measure of the historical movements of the stock price compared to the index of which it is a constituent. A stock's beta can be calculated based on anywhere from a 36 to a 60-month regression analysis of the stock's returns against the index. If a stock's beta is 1, then over the regression period its returns have been the same for the index. However, this does not mean the returns were always identical. A high beta stock will have a beta over 1, for example 1.25. A low beta stock less than 1, for example 0.38. Okay, so let's go over the formula for beta. Beta equals the covariance of returns for the stock, returns for the market, divided by the variance for the market returns. RM equals the average expected rate of return on the market. RS is the expected return on the stock. The interpretation of the beta formula is this. If the index goes up from 100 points, by 100 points, from 5,500 to 5,600, then the stock with a starting price of $46.50 and a beta of 1.25 should theoretically go up to $47.55, an increase of 2.3%. The stock's beta of 1.25 indicated that the price movement of the stock should be 25% greater than the increase in the index, which was 1.8%. If a stock has a beta lower than 1, for example 0.95, as the index increases 1.8%, the stock's price movement should go up, but less than the market. In the previous example, the end price should be $47.23, a 1.71% increase. Let's go through an example, a theoretical example, using random prices and random index moves. Okay, so what's the potential stock price? The S&P, for example, is currently sitting at 4,070. By the year end, it goes to 4,680. For example, the Bank of America BAC share price is, say, 36.67. The BAC beta for 60 months is 1.39. So what is the expected price and the return on Bank of America if the index goes up the 15% as I suggested? Okay, so we said at the beginning of the period the S&P 500 was trading at 4,070. Okay, so we put that into memory, and at the end of the period it finished at 4,680. So what we do is we take that off the original start, which equals 610 index points increase divided by the initial starting point to get a return. So we've got a return of 15%. 0.15, multiply that by 100, gets 15%. So then what we do is we times that by the beta of the stock. Bank of America, as we said, was trading on a beta of 1.39. So at that point, we'll get a total return on the stock of 21%, slightly less, 20.8%. Okay, so let's try and work out if the initial share price was $36.67, let's work out where we would be at the finishing share price. So we add 1, so we can multiply that out. Initial share price was 36.67. We would get an end share price of $44.31. Three quick bullet points in closing regarding beta. Beta indicates a past price relationship. It gives an idea. I can guarantee you one thing, the theory will not work out exactly. It is the stock price versus the index. Thus the beta is specific to a stock. Stocks can be divided into high beta and low beta stocks. This is part of your investment strategy, something you should consider depending on your market view.